Dear students, today we will discuss chapter number 1, Joint Venture, in subject Financial Accounting, paper 2 for first year BCom semester 2, Veer Narmad South Gujarat University. In this lecture, we will discuss about the meaning of joint venture, business activities for joint venture, basic features of joint venture, and accounting entries for separate set of books method. First, let us see the meaning of joint venture. Joint venture is a temporary form of business organization. There are certain business activities or projects that may involve higher risks, higher investments, and even they demand multi-skills. In such cases, an individual person may not be able to master all resources. Hence, two or more people having requisite skill sets come together to form a temporary partnership. This is called joint venture. There is a memorandum of undertaking, that is MOU, signed for this purpose by every co-venturers. In other words, when two or more organizations join hands together for creating synergy and gain a mutual competitive advantages, the entity is called joint venture. It can be a private company, a public company, or even a foreign company. Dear students, here we need to understand few terms. First is, joint venture is a temporary form of business organization. It is for a limited period, not for the whole life of the venture. It involves higher risk, higher investments, and multi-skills. Further, there will be a memorandum of undertaking amongst members of the joint venture. The most important term is synergy. When two or more persons join together for higher risk, higher investment, they should gain synergy effect in their venture. Normally we used to say 1 plus 1 is equal to 2, but when 1 plus 1 is greater than 2, that is called synergy effect. All the co-venturers take higher risk, make higher investments, so they get good return from the venturers. Further, they may take advantages of mutual competitions. By joining joint ventures, the individual competition gets over and they work collectively to get the mutual benefits of competitive advantages. Note, there is no separate governing body which regulates the activities of the joint venture. But once they are into a corporate structure, then the Ministry of Corporate Affairs, in association with Registrar of Companies, keep a check on companies. Apart from that, there is no separate law for governing joint ventures. Dear students, for Partnership Act, we have a Partnership Act 1932. For companies form of organization, we have a Companies Act 2013. In the same line, for joint venture, there is no separate act, there is no separate governing body. But as a corporate, the Ministry of Corporate Affairs and Registrar of Companies keep a watch on joint ventures. Business activities for which joint ventures are formed. First, constructions of dams, bridges, roads, buildings, etc. Buying and selling of goods for particular season. Producing a film or a movie, and purchasing land and selling plots after its development. So dear students, here you can see the business activities in which we can form a joint venture. The construction industries is the best example for joint venture. We can make joint venture for construction of dams on river, bridges on highways or rivers, roads and buildings. As well, we can make joint venture for construction of vessels, aircrafts, etc. Buying and selling of goods for particular season, we can say we make joint venture to sell mangoes during a summer season, or some seasonal festival goods like crackers, kites, colors for Holi festival. We can make joint venture on small scale. For producing a film or movie, we can form a joint venture. And for purchasing, developing and selling of land plots, it can be a residential plot or an industrial gala, we can form a joint venture. Here are some basic features of joint venture business. First, it is done for a specific purpose and hence has a limited time durations. Second, the partners are known as co-venturers. The profit or loss on joint venture is shared between the co-venturers in the agreed ratio. Next, the co-venturers may or may not contribute initial capital. The joint venture is dissolved once the purpose of the business is over. The accounts of the co-venturers are settled immediately on dissolution, and a joint venture has no name because it is for a limited time period and not a permanent business form. So my dear students, these were the basic features of joint venture business. Now accounting entries. For accounting purpose, we have three methods to maintain books of accounts for joint venture business. First is where separate books of accounts are maintained. Second, where no separate books of accounts are maintained. And third, memorandum joint venture method. Dear students, now we will discuss one by one all three methods. First, we will discuss accounting entries on where separate books of accounts are maintained. When separate books are maintained, we prepare accounts like joint venture account, joint bank account and co-venturers personal account. Joint venture account. Like a normal profit and loss account, joint venture account is opened which records all transactions related to the activities carried out, and the net result of this account will be either profit or loss. My dear students, joint venture account is similar to the profit and loss account, which is open to record all transactions related to joint venture, whether it is income or expenditure. And finally, net result of this account is either profit or loss. Second, joint bank account. To record all cash and bank transactions related to joint venture, a joint bank account is maintained. It will record initial contributions of capital made by each co-venturers, proceeds of sales, expenses of joint venture, and final distribution of net balance among co-venturers on dissolution of the venture. And next we prepare co-venturers personal account. It is nothing but like a partner's capital account that we have prepared in the capital in the final accounts of partnership firm to maintain all the individual records of co-venturers. We prepare co-venturers personal account. Now let us see the transactions and its accounting entry in joint venture. Transaction number 1, for initial contribution of capital by co-venturers. Our accounting entry will be joint bank account debit to co-venturers account. Number 2, goods sent by co-venturers out of his own stock. Our accounting entry will be joint venture account debit to co-venturers account. Number 3, expenses paid by co-venturers. So our accounting entry joint venture account debit to co-venturers account. Number 4, material purchased out of joint ventures fund. Accounting entry joint venture account debit to joint bank account. Number 5, for expenses out of joint bank account. Our accounting entry joint venture account debit to joint bank account. Number 6, for goods sold for cash. Our accounting entry joint bank account debit to joint venture account. Number 7, for contract or a sales price received in cash or in shares. Our accounting entry joint bank account debit, shares account debit to joint venture account. Dear students, try to understand here in all the transactions we have applied 3 golden rules of debit and credit. In first entry, initial contribution of co-venturers. So by initial contribution, cash or bank account will be debited and capital account will be credited. So here our entry comes joint bank account debit to co-venturers account. You can understand here co-venturers account represents capital account of co-venturers. Then in second transaction, co-venturers gives goods to joint venture. So for that purpose our accounting entry will be joint venture account debit because goods are given for joint venture, and an individual co-venturer's account will be credited because he is a giver. Then expenses paid by co-venturers, expenses in relation to joint venture, so joint venture account will be debited. And who pays? It is co-venturer, so co-venturers become giver, his capital account will be credited. Then material purchase out of joint venture funds. Here the material is not given by any individual co-venturer. It is purchased out of joint ventures fund. So our accounting entry will be joint venture account debit to joint bank account. Same way, expenses paid out of joint bank for joint venture. So our entry will be joint venture account debit to joint bank account. The next, goods sold for cash. It is income of joint venture. So joint venture account will be credited and joint bank account is debited. Then contract or sale price received in cash or shares. So joint bank account debit, shares account debit to joint venture account. Like this, transactions are recorded in joint venture. Transaction number 8, commission or salary payable to co-venturers. Here commission or salary is expense of joint venture, so joint venture account debit to co-venturers account because co-venturers are the benefit giver to the joint venture, so their account will be credited. Unsold goods taken over by co-venturers. co-venturers are the receivers. So co-ventures account debit to joint venture account. Shares taken over by co-venturers. Co-venturers are the receivers. So co-venturers account debit to shares account. If shares are sold in open market, so our accounting entry will be joint bank account debit to shares account. For profit on joint venture, our accounting entry joint venture account debit to co-venturers account, because profit will be distributed to co-venturers account. For loss on joint venture, our accounting entry will be co-venturers account debit to joint venture account. Reverse entry then for profit. And last, for final distribution of funds among co-venturers, our accounting entry will be co-venturers account debit to joint bank account. My dear students, I hope you people understood the transactions of joint venture when separate books are maintained. Thank you very much for watching this video lecture. Very soon we will meet with another video lecture with solution of sums of joint venture of first method.